All right, so Mark, we're kind of keeping in theme with the Mr. Miyagi tariffs on, tariffs off, interest rates high, interest rates low, bond yield high, bond yield low. What the heck is going on, man?
Man, I'll tell you, it's crazy because we're tariffing this, we're putting a tariff on that, we're accepting this condition, and maybe no, we're going to negotiate. No, we're not going to negotiate. Okay, yeah, fine, we'll negotiate. Are you confused yet?
I've been confused. Yeah.
Because so are the markets. And so what's happening, normally you see when the stock market is doing well, then people fly to the stock market. When the stock market is not doing well, they go to bonds,
Right.
10-year bonds, the mortgage-backed securities, and that sort of thing. And so in general, when people are buying bonds, then it doesn't have to yield as much
Right.
to attract investors, which is what keeps mortgage rates down, right? So, and then of course when the stock market does well, now last week the market and bonds were not doing well at the same time.
Yeah, I saw that. Yeah.
So then, to give you an idea, the 10-year bond yield was something like, it was right under 4%, for a while there, and then all of a sudden it started to climb, and started to climb because they're raising the bond levels to attract investors. And on top of that, to make things worse, people sell bonds for all kinds of reasons this time of year, like taxes, for example.
Right.
To cover, the government's they're selling bonds because they're trying to create income revenue that's being lost from the tariffs
Right.
to
Sure.
keep things running. And so, and there can be all kinds of other reasons too, but people are pulling back from both. And so there's something like $7 trillion just sitting on the sidelines, waiting to see what's going to happen.
Yeah.
Because they're afraid to invest in either right now. So then, bond yields are up to attract investors, and stock market was not doing well. Don't look at your 401k
Yeah, definitely don't.
because it's scary.
If you have an E-Trade account, just change the password and write it down somewhere, put it in a safe, and pretend it doesn't exist until
Yeah.
we get past this. But so, okay, let's talk for a second the bond market and how that relates to real estate, because everybody thinks that, okay, real estate mortgage rates, that's what these guys talk about on Two Guys Talking Houses, which they would be right in that assumption. But the whole market kind of has to be considered and looked at. And a lot of people think that it's just the federal funds rate that's going to lower your, when the federal funds rate lowers, then mortgage rates tend to follow. And while that's not entirely untrue, there's more factors to it. So what did we see? We saw the bond yield drop to 3.9-ish.
Yeah.
Where were rates when that happened? And then now that it's gone back up, what's it, almost a little higher than 4.25 now. How have rates responded to that?
So, and there's an old adage we have to keep in mind on rates.
Yeah.
I always tell people, rates take the elevator up and the stairs down.
Yeah.
So even when things do improve, they're not improving at the rate everybody wants because, they're just not going to. That's not how it works, because some of the investors kind of hang on and they wait and see a little bit, right?
Yeah.
So that's important to note. But back when the 10-year was down, I mean, we were seeing FHA rates 5.75
When it was at 3.9.
Yeah. And now keep in mind, I just always, when I talk about rates, I don't talk about buying them down. Just whatever the
Right.
raw rate is, like if you want to buy it down from there, absolutely. We'll have that conversation. We'll do that. But understand, a lot of lenders do quote rates with a point or 2 points or whatever. So anyway, but when we talk about national averages, that's what we're talking about.
Right.
And then and then FHA went up to something 6.5. Almost a 3/4 swing.
Yeah.
And so in some cases 6.625, depends on where you are. Conventional was down in the low to mid sixes, and then now we're seeing 7%. I mean, it went up a whole point in some cases.
Yeah.
Different scenarios. Your results may vary, but point is that I mean, we've seen quite a swing, and then it has come down, but we got to keep in mind, what are people afraid of? Do you know what people are afraid of?
They're afraid of a huge market crash. I have a
Right.
couple of buyers currently that are very afraid that the market's going to crash. And by crash, they think it's going to be a 30 or 40% correction in the real estate market. And I think that's kind of the next point that we wanted to talk about there.
It's more than that. So keep in mind, like if they're looking in history, now I know you're a little bit younger than me,
Just a few years.
but I also wasn't around during the Hawley Smoot tariff thing.
Not in the 1930s?
Yeah, I know. The 1930s, it's surprising, right? But the deal with this thing was that, we were going into the Depression. Hoover was president. Hoover decided to protect the farmers, U.S. farmers, that he would put a tariff on agricultural goods imported into the United States from other countries to make U.S. farmers' goods more attractive. So that was the whole point. Now, this had to get passed by Congress because at the time the president could not negotiate tariffs. So Congress added 890 other products. They got a tariff up to 20%, in some cases. And so in response to that, by the time it got through Congress, it looked like a totally different animal. And he was warned. Hoover was warned, nope, don't sign this one. Bad idea. It's going to kill the markets. Don't do it. But he did it anyway. He signed it into law, and what do you know? Things went south in a hurry. So, the U.S. at the time was exporting something like 12 million eggs to Canada. Yeah, that went to about 170,000.
Wow.
Huge drop. 80% drop in U.S. car exports, 80% drop in steel. I mean, it was just like anything and everything was going to crap. And the whole country and the whole world plunged into the Great Depression that we know today. And so that is what everybody thinks of. Not everybody, but a lot of people think of when they think of tariffs. Is like, oh my gosh, this is going to happen all over again. We're going to be in the Great Depression.
Yep.
Now, in 1934, Roosevelt was elected. And Roosevelt, one of the first things he did is he came along and he said, okay, we got to put a stop to this. We got to negotiate some of these tariffs. Sound familiar?
Yeah, it does. Yeah.
Right. We got to negotiate some of these. The problem with Hoover is he was unwilling to negotiate. This is it. This is it. This is what it is. And too bad if you don't like it.
Yeah.
Also might sound familiar to what we started with these tariffs. Trump, we're not negotiating. Like, what are you, crazy? And then, all of a sudden it was like, okay, let's make a deal.
Right.
And so anyway, back to the history lesson, right? So Roosevelt, decides, hey, we're going to pass a law that says that the president has the ability to negotiate tariffs with other countries in the best interest of the country. And most of the time, that was negotiating the tariffs down.
Right, sure.
Obviously, recently, we've seen a change. That was up, not down, but then down, then up, then down, sideways, this way, that way.
Yep.
This is included, but that's not. But under these certain conditions, if the moon is right, then it's that, right?
Yeah, that's about right. That summarizes it, yeah.
And so that's what people have in the back of their minds, investors have in the back of their minds, is, oh my gosh, this is going to happen again. But it's not, because we're seeing negotiation. We're seeing a little easing by the president and his administration.
Yeah, and that's kind of where, things get interesting, because that's what's causing a lot of this market uncertainty, is because you see these reciprocal tariffs, you see China retaliating, and then we retaliate to their retaliation, and it's causing a lot of market uncertainty. And then you see the announcement that there's going to be a 90-day pause with the exception of China, and that there's going to be some negotiation. That brings consumer confidence back into the fold. So that's why you're seeing, as you said, you're closing deals with rates in the high fives, and then you look day before yesterday or whenever it was, and they're in the sevens. And so it's a huge swing, and that's kind of what we're experiencing right now. And we're trying, myself as a real estate agent and you as a loan officer, helping clients navigate through this whole situation is challenging.
Can I tell you a secret, Stephen?
Yeah.
The competition will not like anybody to let this out of the bag.
Well, we won't do it then.
But most lenders have some sort of float down policy.
Okay.
So lately we've been in the mode of, if you like it, lock it. Or I know you don't like it, but if you can live with it or qualify for the loan with it, then let's lock that rate right now. I don't care that it's 6.75 or 7% or whatever it is. If it goes up, you're protected.
Right.
If it goes down, we'll go get you a lower rate. You're not going to lose out. And that's kind of the mantra right now, is like, hey, you know what? And, right now we're in the broker world, so We've actually had some of the lenders that we broker loans to tell us, like, yeah, if it goes down, absolutely, go take it somewhere else. Like, lock it with another lender.
Yeah.
You go get that better rate if you can. And, it's within reason. If the time, if it's 2 weeks from closing or whatever, okay, probably not a good idea.
Right, sure.
But if it's, if it's 30 days or something, or, 3 weeks out, yeah, we do that. And we've gotten loans clear to close in 7 days before. And, y'all you hear those stories all the time, right? Hopefully in our industry.
Yeah.
But I know it happens with us. And so, yeah, I mean, you could flip a loan to someone else and that would take care of the problem.
Yeah.
So, but where does this all go?
Well, and I want to revisit really quickly the thought and discussion around a lot of people saying that there's going to be another Great Depression and that this is going to be 2008, but way worse. And I think it's important to note, and you and I were discussing this before we started rolling the cameras, 40%, I think it is, of homeowners don't have a mortgage on their house.
Yeah.
And the vast majority of the rest of them have, 47% loan to value, meaning that they owe less than half of what the house is worth. So there's tremendous equity. And those people generally have a rate under 4 or 5%. So it doesn't really seem like it's on a rocky cliff like everybody seems to think. And if you watch the news too much and consume too much of that type of content, you're led to believe.
Well, and that's sort of the problem. Like, the news doesn't talk about the guy that has owned his house for 25 years and it's paid off, or he maybe took an equity loan out to send his kids to college at like 3%. They don't talk about that because that's not new. Like, nobody wants to hear that. Like, they don't watch, they tune in and you say, oh my gosh, rates are going to, to heck in a handbasket, and oh my gosh, we're all going to die, and the sky is falling, and, Chicken Little's running everywhere, whatever. But, that sells, right? It sells news, and people tune into it. And,
yeah.
Or they don't really tune into it, or they read it on Facebook, right? That's exciting.
Where everything is true.
Yeah, exactly, because it's the internet, right? And so not a lot of people are talking about that guy, but he does exist.
Yeah, he's actually the majority, probably.
Yeah, and at this point, and nobody really thinks about that. But I was reading an article, and it was saying that I was like, I don't know. And I started thinking about it. I'm like, you know what? Actually, that has some truth to it. Because, you think about our baby boomer population is now seniors, right?
Right.
So all those folks, and then anybody who bought a house before COVID experienced significant growth in the value.
Yeah.
Right? So that's good. So yeah, I mean, there's a ton of people in that situation. And really, if things really got bad in the economy, in 2008, it was a pretty simple solution. You had 3% equity, if that, in your house. Just give it back to the bank.
Turn those keys in, yeah.
Yeah, we'll just give it back, as they say. Well, people aren't doing that because they got a ton of equity in it. They're going to fight like heck to make sure they don't lose their house now.
Sure, yeah.
Totally different environment than we were in 08. I lived through 08 and 06 and 7 and all. It was not a fun time, and it was much different than what we're seeing now. I just wanted to say, before we get back to the conversation, we've noticed a lot of folks are not subscribing to the channel, and it really helps us when you do. So if you're enjoying this or getting something out of it, or just want to leave comments, or, you don't want to miss an episode, hit that subscribe button, hit that like button. It really helps us out.
Thanks so much. Now back to the show. So to summarize everything and kind of bring the conversation to a close, what do you think? So I know you mentioned the word yippee, that so explain how that comes into the fold, but then also, it looks like Trump saw the reaction to the reciprocal tariffs. A lot of countries came to the table and said they want to negotiate. The tariffs took a 90-day pause for the countries that are willing to negotiate. China's the main exception. We saw mortgage rates in the high fives all the way up to 7, even since the last time we recorded a video, which was just over a week ago. So where do we go from here? Where does the consumer go from here? The person who's looking to apply for a mortgage or buy a house, who's a bit confused by all the chaos.
Well, the first thing, the yippee comment came from the president when he paused on the 90-day tariffs thing, which was more funny than anything, but okay.
Yeah.
And then, today they clarified and said, hey, you know what? The electronics, that's an exclusion. So your toaster that has a semiconductor in it, or chip in it, or whatever, okay, we're not putting a tariff on that. And that seemed to really signal some good things in the markets. And so now stocks did better, and bonds were doing better. It was people were buying, so therefore the yields were lower,
Sure.
and rates did start to come down. And I think that's going to continue. But really, the thing about it is there's actually a ton of inventory out there building. A lot of houses are sitting. And if you start running the numbers, your choices are either to rent, right? Mm-hmm. So you could live with a relative, but sometimes that costs more in other ways than money than it's worth. Like if your parents, like there's a reason we all moved out of our parents' house at some point in time, right? Because I could not, as an adult, live there anymore.
Right.
Mom, love you, but yeah, no thanks. But anyway, but then if you look at like I can buy a house and it's this much, and I can rent a place and it's this much, and it goes up every year, and it's not my place, and I have to, I have to do what the landlord says, and oh my gosh, this has been broken for months, and you got to deal with all that. Like where do you really find a cheaper place to live?
Yeah.
And how much cheaper is it really? It's not a bad time to buy. Yep, rates are elevated because all the tariff thing. But you know what? Lock something in, and if it goes down, pester your lender until they give you a lower rate.
Yeah.
And you can tell them I said that.
There you go.
Like, yeah.
Straight from the horse's mouth.
I'll get a lot of comments there, right?
Mark Elliott, Milo Mortgage.
Mark Elliott, Milo Mortgage,
MarkDoesLoans.com.
You're right. I don't, just, go ahead and send the hate mail. But the reality is that's what's best for the consumer anyway in that situation.
Yeah.
Is, if rates are coming down, we want to do whatever we can to help that situation. It costs a little money sometimes, but it saves the buyer so much more down the road.